Trading gold and silver coins involves leveraging nature as a kind of ledger. This means relying on the inherent properties of these metals, such as their difficulty to mine and their physical characteristics to maintain their value. Nature essentially governs the supply of gold and silver, and we trust that these properties will remain consistent over time. While technological advancements in other commodities can sometimes disrupt this balance, gold and silver have remained resistant to such changes, which is why they continue to be considered valuable monetary commodities. Uh, Whether we trust nature or human systems to manage value, maintaining confidence in the ledger is crucial. In the modern fiat currency era, this trust is often tested and can be compromised. Thus, ensuring that our money retains its value requires a dependable system or ledger that we can rely on. Gold and silver have historically provided this reliability, given their consistent and relatively stable characteristics compared to other assets subject to more volatile technological economic changes.
Trading gold and silver coins is an exercise in using nature as a kind of ledger. The value of these metals is derived from their inherent properties, such as the difficulty of mining them and their physical characteristics. Essentially, nature governs the availability and characteristics of gold and silver, providing a stable foundation for their value. This stability comes from the fact that, unlike other commodities, gold and silver have been resistant to significant technological changes that could alter their fundamental properties. For example, new technologies might make it easier to extract other resources, potentially skewing their value, but gold and silver have maintained their consistency over time. In contrast, in the world of modern fiat currencies, this trust in the ledger is often tested. Fiat money relies on human-managed systems, which can be prone to volatility and mismanagement. The value of fiat currencies can be influenced by numerous factors, including economic policies and market fluctuations, leading to potential devaluation and loss of trust. Thus, when dealing with gold and silver, we're relying on a natural ledger that has been remarkably consistent. This natural consistency provides a level of assurance that the value of these metals will remain relatively stable. Despite technological advances and shifts in the financial system, gold and silver have maintained their role as reliable monetary commodities. This contrasts sharply with fiat currencies, where trust in the value and stability of money is more susceptible to human errors and systemic failures. In this environment, the enduring properties of gold and silver offer a form of financial stability that is increasingly rare in the modern era.
Subscribe our channel and press the bell button to get our video notification. And like the video.
I frequently use Egypt as an example because I spend part of each year there. The country is experiencing over 20% structural money supply growth annually. In Egypt, many people, especially those with lower incomes, operate in a cash economy since the banking system isn't as widespread among the lower income population. While the middle class and above are generally banked and may earn interest on their savings, a significant portion of the population relies on cash for savings and transactions. For these individuals, holding Egyptian pounds is like trusting a ledger that's being actively weaponized against them. Unlike visible taxes, where you directly pay a percentage of your income, inflation and money supply growth function as an invisible tax. If you receive annual raises but the money supply is expanding by 20%, both your wages and savings are effectively being devalued. This dilution happens behind the scenes, making it less apparent but still impactful. Gold tends to have a more stable property. Historically, gold has a dilution rate of about 1.5% per year on average, which is far better than the long-term average dilution of about 7% for US dollars.
I often refer to Egypt because I spend part of each year there, and the economic dynamics there are quite illustrative. Egypt is experiencing over 20% structural money supply growth annually. This has a significant impact, particularly on the lower income population who largely operate in a cash economy. In Egypt, banking is less prevalent among the lower income groups, and many people rely on cash for their savings and transactions. The middle class and wealthier individuals are more likely to be banked and may benefit from earning interest on their savings. but a substantial portion of the population is not as financially integrated into the banking system. For those holding Egyptian pounds, the situation is quite dire. With the money supply growing at such a rapid rate, the value of their savings is eroded significantly. This is akin to having an invisible tax levied on their money. Unlike direct taxes where a percentage of income is deducted visibly, inflation due to money supply growth operates behind the scenes. If you receive a raise of, say, 5 to 10% per year, but the money supply grows by 20%, both your income and savings are effectively devalued. This hidden erosion of value is less noticeable but still very real. Gold offers a contrast to this scenario. Historically, gold has a much lower rate of dilution, averaging around 1.5% per year. This is considerably better than the long-term average dilution rate of about 7% for US dollars. In fact, many market currencies experience even higher rates of dilution. While gold is not completely immune to value erosion, it provides a more stable store of value compared to rapidly inflating currencies. In a high inflation environment like Egypt's, gold can act as a more reliable hedge against the invisible erosion of purchasing power.
When considering currencies, the recognition and liquidity of the currency play a crucial role. For example, a diluted Spanish currency might still be more practical in terms of debt obligations and liquidity compared to smaller, less recognized currencies. The larger, more familiar currency, like the Spanish one, tends to have a higher acceptance and ease of exchange because people are familiar with it and it's widely used. In contrast, a smaller or less recognized currency might face challenges in finding buyers or users, leading to friction in transactions. Take Norway as currency as an example. Norway is one of the wealthiest countries per capita, and I personally have Norwegian currency on hand. However, if I were to use it in New Jersey, it would be challenging to exchange or spend it because it's not commonly used or recognized in that region. Even though Norwegian currency is strong, its lack of familiarity and limited usage create obstacles. This dynamic illustrates the importance of network effects in currency adoption. For a currency to become widely accepted, it needs to overcome these barriers. The BRICS alliance, which includes countries like China, presents a significant shift in this landscape.
When discussing currency dynamics, recognition and liquidity are key factors. For instance, a diluted Spanish currency, despite its reduced value, remains more practical for debt and transactions due to its established liquidity and recognition. Larger, widely used currencies tend to have an inherent advantage because people are familiar with them and they are widely accepted. In contrast, a smaller or less recognized currency can face significant hurdles. If people don't know the currency or how to evaluate its value, it becomes harder to use or exchange, creating friction in transactions. For example, Norway's currency, despite Norway being one of the wealthiest countries per capita, can be difficult to use in places like New Jersey. Even though the Norwegian krone is strong and stable, its unfamiliarity and limited circulation outside its home country make it challenging to exchange or spend. This highlights how the acceptance of a currency depends heavily on its familiarity and usage within a broader economic context. The BRICS alliance represents a shift in global currency dynamics. With the United States comprising only 4% of the global population and less than 25% of global GDP, its currency alone may not be sufficient as the global reserve currency. Countries like China, which have a comparable or larger GDP in various metrics, are exploring alternative currencies. They and their trading partners are considering shifting towards their own currencies or creating multi-currency systems to better suit their economic needs. This transition reflects a move towards diversifying and decentralizing the global financial system, challenging the dominance of the US dollar.
Subscribe our channel and press the bell button to get our video notification. And like the video.